I'm like any other human. I mean, do the best you can to try to anticipate what's what, make good decisions, and at the end of the day, just do the very best you can with character and competence. And that's really all I know how to do.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. I'm your host, Jack Krupe, and we've got a great guest today. I've known Matt for a number of years, worked with his firm, actually invested in a deal or two with his firm as well, and they're one of the groups I've modeled JCAM after, at least on the Fairway side, but he also runs Verivest, and we're going to talk a lot about real estate funds and syndications today. So Matt, thank you so much for joining.
My pleasure, Jack. Thank you for having me.
Well, let's start off with just having you tell your story. I'm always fascinated how people got into the alternative investment space because I really think more people should have more exposure and more participation in, outside of the stocks and bonds. So yeah, tell us your story.
Yeah, well, I started out of school coming into the real estate finance world, bounced around at a couple of shops early on to kind of cut my teeth and learn about the business. And then company that I was working for got kind of caught up in the early 90s S&L crisis, and so they shut down a bunch of offices, and I started my own company in 1992. So started doing brokering real estate loans initially, and then over time, Jack, we went and did a lot of private money deals where we would find individual investors that were looking for alternative investments, secured by real estate, and we would match up one deal at a time. We'd find the borrowers and we'd put the deal together, and we'd find the investor and match it up. Eventually, we started doing the servicing, so collecting the payments, keeping a spread, and doing that at scale. And then at some point, I decided, well, maybe doing this in a fund format made more sense. So we moved to that, and that kind of gave rise to a long career in doing funds and syndications and helping other people do it, and ultimately doing fund administration and so forth. So yeah, been in it a long time, started as a real estate lender and kind of gradually, got into the alternative investment space in a much bigger way.
That's great. So when you started, there was no 506c at that point. It was so how different was it back then to try to get the word out to investors?
Yeah, it was, much less. Obviously, technology wasn't around. The internet was, not even around in the early 90s. It was just kind of starting. So it's a whole different world today than it was 30 years ago when we started. But in those days, you would have to do it kind of the old-fashioned way. Find people you knew, other people that were doing it, referrals. Local. It was really very local. There's a lot of people in the area in which I live. We would do things like find people's name in local publications. There was a publication called the Daily Journal of Commerce that would put out all of the recordings that happened at the county in the last week or two, and it would name the beneficiaries of trust deeds. And so we'd look through that, and you'd see Bank of America and a lot of institutions, but every now and then you'd see a name, an individual. So we'd highlight that name and we'd figure out who they are and try to track them down, send them mailers. A lot of things like that back in the early days. This is before we even had any funds. So yeah, things have changed dramatically. Obviously, social media and the internet makes it a completely different ballgame. But it's just a lot of hard work and a lot of referrals and a lot of people that you knew.
Yeah, that's great. I got my start in the early 2000s, and certainly did a little bit of data mining. In some ways it was better because it was a much less efficient market. Now it's I go on Facebook and we do some advertising, and I see multiple I'm barraged with ads. It's like they know me better than I maybe know myself at some point. I'm getting ads for things I didn't know I wanted to buy yet. So it's definitely different. So tell us a little bit about your services. I know you have the Fairway side and you have the Verivest side. And talk a little bit about kind of the syndications, SPVs, and managing funds.
Yeah, I think Verivest is really a service provider. I think coming out of the Great Recession, Jack, we started doing work for people. Had a number of folks coming to me asking about setting up a fund, and we started a line of business doing that in about 2012. And since that time, we've really set up hundreds of funds for other aspiring fund managers, real estate asset-based fund managers around the United States. That gave rise to doing a lot of back office work in fund administration. And we ended up creating a company which was originally called something else, but it's now branded as Verivest, that does fund administration, pooled fund accounting, investor statements, et cetera, for fund managers. So basically, Verivest does fund advisory, helps people think through, set up funds properly in the first place. It does the back office advisory. Fairway is an investment company that will make investments in and alongside a lot of the managers that we bring through the Verivest platform. So combined, I think the companies are very strategically integrated. But one is a service provider and one is an investment company.
Gotcha. What are some mistakes you've seen people making, either those that are not working with you, that were making mistakes before they started working with Verivest?
Sure. Yeah, well, I think it's very common that historically, if somebody wanted to set up a pooled investment fund, really the place that you would go is a lawyer. And of course, you have to have lawyers that represent the fund manager and sign off on all the offering documents. That's absolutely necessary and a part of the equation. But lawyers, by and large, have not run funds themselves, so they come at it from one angle. So I do see a lot of people who have set up funds that are legally appropriate, but don't at all match their asset model, or have a fee structure that doesn't work, or is incapable of being administered, or has any number of other challenges that they unknowingly create for themselves going into their life as a fund manager. So we help them avoid a lot of those problems by bringing real world experience in the seat as a fund manager, right? And having done it many times ourselves. And I think that anytime you can get, practical guidance and direction from people who've done what you're trying to do, that of course makes a lot of sense. So we come at it very much from a practitioner's perspective and help them avoid a lot of those structural mistakes that you don't want to make going into launching a fund.
Yeah, that's super powerful. I was fortunate that I had another fund that I'd invested in myself, and I was friendly with the owners, and they had a very similar model. So I actually used their same attorney and was essentially adapting their PPM, because if you're just going in just from the start, customized, you could spend $20,000-$30,000 or more.
Oh yeah.
Whereas
I've seen people spend $100,000 or more on documents that they never even ended up launching the fund at all. So it can be very expensive.
Yeah, absolutely. And even I know on our side, we had to clean up a few things. We had some issues with the way the capital accounts were tracked and the way K1s would flow through. It wasn't as we originally intended, and it just got missed because it was boilerplate language. And it was in multiple spots, but even us on our second fund, we cleaned up some things that were in the first fund. So you guys, having done hundreds of them, should head off a lot of those issues.
Yeah, sorry, Jack. You're having some internet problems there, and I missed that last part. So my apologies.
Sorry. Yeah, I don't know. I didn't know whether it was me or you. So, all right.
You were freezing up on there for me for a minute, so maybe it's on my end, but you were frozen. I didn't hear what you said there. I apologize.
Gotcha. Okay. Well, they'll edit it together. Yeah, I was saying, even with our fund, we had to clean up some boilerplate language in our second fund that wasn't as intended. We had some issues with the way the capital accounts were tracked, where the K1 pass through wasn't as optimal as we would have thought, and it was just boilerplate language that didn't get caught. So I imagine you guys, having done hundreds or maybe even 1,000 plus PPMs over the years, a lot of that's pretty well refined and can be reused rather than written from scratch.
Yeah, and it's very, very common what you just described. And I would say even very sophisticated managers that are on multiple funds, it's like you learn new things all the time. So I think sometimes, and look, we've been guilty of this, and frankly, that's what makes us a pretty effective advisor is that we've made a lot of mistakes over the years that we can help people avoid, right? So, for example, you can do things that you think are going to be very conducive to helping you raise capital, multiple classes of shares, different prefs. But they become difficult or impossible to administer, or they create back-end administrative problems that you just didn't even know that you had, going in. So I think a lot of those kind of things can be avoided if you handle it properly, and that's really what we try to help people do is go into it making as few mistakes as possible.
That's great. Let's pivot a bit. I talk to a lot of investors, and there's a lot of fear and concern in the market right now with the rise in interest rates. And you're someone. I'm in a lot of deals. I think we're in over 40 different allocations into different syndications. I'd imagine between your own investments plus all the all the funds you administer. Talk a little bit about what you're seeing in the market today and how funds are handling this dramatic rise in interest rates.
Yeah, man. The fear and the uncertainty is absolutely justified, right? There is a great deal of uncertainty in the market, and uncertainty, as you well know, gives rise to people not wanting to do anything. So it's as difficult a market conditions as I've seen in my career of 30 plus years, including the Great Recession. There's a lot of deals that are very, very hard pressed to figure out how they're going to return capital to investors because, values have eroded. If you look across the board and say, a lot of values are down 20, 30, 40%. And if you finance them at 60, 70% leverage, then, doesn't take a mathematician to figure out that the equity, in many deals is in trouble. So I think things that have floating rate interest, or things that are in the middle of value add that haven't been stabilized yet, all of that stuff, people are handling it in different ways. A lot of capital calls going on, a lot of negotiations with lenders. I think it's a market that is quite scary, right? So I think good fund managers, it depends on what they are, right? If it's an open-ended fund, that's one thing. If it's closed-ended, that's another. As to how they handle it, right? But I think you're seeing a combination of capital calls, renegotiation of existing debt. There's a lot of money that has come out now for kind of rescue capital, mezz and pref type solutions, and so it's a crazy market environment, no question about it.
Yeah. I've been fortunately a few of the deals that we're in with bridge debt just got modifications, which was I feel it. I wasn't panicked, but there were a few that it was a pleasant surprise to see that the lenders were playing ball. And I've used that analogy that if you owe the bank $1 million, you're screwed. But if you owe the bank $1 billion, they're screwed. And
there's no question, Jack. I think lenders have been trying very hard to avoid having to do that, but I don't see how they avoid it completely because the market is just going to get to a point, or is getting to a point very rapidly, where lenders are going to have to play ball. It's either that or what are they going to do? Take the keys back, take them over themselves, and then they don't have the wherewithal, the bandwidth, the expertise to do it. If you've got a competent and a sponsor who's got some character, they're far better off managing through the situation than the lender is, right? But that requires the lender to play ball, to your point. So I think you're seeing more and more of that happening now. People going back to lenders and saying, "Hey guys, this is what needs to happen." I see that happening quite a bit now across the spectrum of this industry.
Cool. And then I see various articles. It seems like every week there's another article about what rents are doing. And I know and we're heavily focused on the Class B value add space. So I'm just curious, at a broad level, what are you seeing across your portfolio? Are rents dropping in any markets, or is that just the higher end of the market, whereas the kind of the middle class value add market's been relatively stable in a bulk of your investments?
Yeah, I would say there have been I'd say the lower you are on the rent scale, the less of a percentage decline you would see. And in some cases it would hold steady or still have some rent growth at the very bottom of the market. But the higher you go up, right, the more expensive it becomes, the less likely that is, and the bigger the percentage drop. And I would say it varies also by market. So yes, rent growth has clearly subsided substantially from where it was. But again, market by market, bigger drops in higher price points, lower drops and lower price points.
Gotcha. I think we're seeing about the same thing. It's like anytime I see one that says the sky is falling, it's not generally. It's the higher end of the market's usually where the headline comes from. But overall, we haven't seen any of the 40 deals we're in. I don't recall any where we've seen any dramatic drop in rental prices. I think there's just it's hard to buy a house, and the middle class is sort of priced out of buying a house, and then, we may have at least a generation of renters, unless rates come down in the short term.
I think there's been less. I think if you look across all of the issues that commercial real estate is facing, rent is particularly in multifamily, right? Rental decreases is probably much lower on the list for most, especially Class B, Class C, kind of lower end, affordable and middle class stuff, than many other issues like rising insurance costs, rising taxes, drop in cap rates, difficulty selling things, higher interest rates. All of those other things have had a much bigger impact on the market than the rent growth. You add them all up together, and of course, it makes for a extremely challenging environment. But I'd say rent growth or droppage in the non-Class A space has been, to your point, not as bad as maybe as people might think.
Yeah, that's been the good news I've seen across the portfolio. I keep using the analogy that you kind of have to just renovate your way out of it. A majority of the deals that I'm involved in, the whole plan was to do value add, and that didn't need to have just rent inflation. It just needed to execute on the value add strategy. So, my hope is across a majority of the projects, if the value add is still completed, investors may not make the money they expected because, cap rates have expanded. Maybe cap rates expand 20%, from a 5 to a 6 or a 4.5 to a 5.5. But if you're raising a net operating income 30-40%, you're, hopefully still in the money if the interest rate didn't eat up all your profits.
Yeah, and that's the whole thing. Is like, does the interest rate eat up all your profits? Is there even a market to be able to sell it? Can you get new debt if you need it? If you got rate adjustments coming up or you got maturities, how do you get new financing? There's lower advance rates, which requires more equity. So it's, there's a lot of things out there that justify people's nervousness in the market these days.
Yeah, and it absolutely comes down to the sponsor. I mean, we've seen situations where our sponsors have written 7-figure checks themselves just to keep renovations going while they were waiting on construction draws, or they flew down employees on site because the property manager was short staffed and they actually filled the gap with their own people. You guys have partnered on tons of deals for 20 plus years. What do you look for in an operating partner, the top tier of operators that are the ones that you guys may participate with in the fund of funds model?
Yeah, I think character and competence are the two highest criteria, right? You want people who will do the right thing, and like times like these, Jack, would test people's character for sure, right? You find out who's willing to roll up their sleeves and do what it takes in times like this, right? Not when everything's going great. So character and competence are the two biggest things. Obviously, if somebody has a sizable balance sheet and can write 7-figure checks or any checks to keep things going, but that all boils down to somebody's financial wherewithal. So, that's not always possible for people, but you want people that'll do the right thing and that will stand in and take the fire and get things done as best they possibly can. I mean, really all you can ask for is people that will do the very best that they can under whatever circumstances they're dealing with, right? It's like that's what we look for more than anything else.
It's a great answer. So you've been through, you mentioned you started kind of, the savings and loan, I think you mentioned was sort of part of the initial issue that caused you to jump and start your own company. So you've been through kind of that, at least experience the savings and loan in one way, and then 2008 and COVID, and now, like, where does this rank? And, if you're looking back across the cycles of your career?
I would say this is up there with the Great Recession, and depending on how long it lasts and how bad it gets, I think for specifically as it pertains to commercial real estate, right? I think this one is as hard as any of them that I've seen. So yeah, this is a real serious one. I mean, it's just like it doesn't take floating rate debt was at, what, 6.5%, 7%, a year ago, a little over a year ago. And now it's at 12, 13, right? It's nearly double what it was, as recently as a year ago. I mean, it's just hard to absorb those kinds of increases and all of the concomitant, downstream effects. And even back then, I think generally speaking, the economy is a lot healthier than it was back during the Great Recession, because obviously you had all the subprime issues and so forth that pose systemic risk. But I think this is more of a shock to the system more quickly than it was back then, and remains to be seen ultimately how bad it really gets. But it's definitely up there.
Yeah, and I've been following the 10-year really closely, and I think back to earlier this year when Silicon Valley Bank failed, and the 10-year dropped 0.5%. I think it was in the threes, it was like 3.5%, and that gave me a lot of hope, because at least you could refinance out of the bridge debt into relatively cheap 10-year debt. The 10-year didn't move at the time, hadn't moved nearly as much, and it still hasn't moved as much as SOFR, which the bridge debt's based on. But the 10-year is up at 4.5% right now, which means a long-term refinance is probably 6.3, 6.5. And that's actually more concerning to me, because that just makes the long-term refinance an issue. Are you, obviously your crystal balls might be broken, but what do you think, if you had to venture a guess, what is your take on kind of how long interest rates stay up, and at what point they may start coming back down?
Yeah, man, I mean, I get asked that question a lot, as do a lot of people, and it's sort of anybody's guess. So, I think, like you said, my crystal ball's not any better than anybody else's. But if I had to guess, I mean, I like to think that it's getting, at or near a peak. And if it just holds steady and we get a little bit of calmness in the market and you get some people back into it, I don't think rates need to go back to where they were. I don't think that's going to happen anytime soon, but hopefully they level off and maybe taper off a little bit sometime in the next, 6 months to a year. That feels like the most likely scenario to me. That said, maybe it may happen, may not. I don't think it probably happens any faster than that, most likely. And if you think about it in historical terms, Jack, I mean, the rates where they're at today are not, at historic highs compared to other periods in the market. But I just think the duration of time that they were low and the speed with which they went up, is what's really causing, a lot of these problems, right? I think you could see a compression in cap rates at some point in terms of spreads above interest rates if the market was functioning normally, but that's a huge if, right? And it's not functioning normally right now. So, what is a cap rate today for any given asset type? I mean, it's really hard to even figure out. I mean, to underwrite anything with much certainty at the moment is very, very difficult.
Yeah, very, very, very well said. So with all that, what is your personal or company investment philosophy right now? Are you looking to get aggressive and find some good deals and get into deals that if the numbers pencil with this type of interest rate, there's, a lot of upside if rates do move, and or just sponsors that have bridge debt that are, going to be very motivated sellers if they, either have to do a cash in refinance or are just ultimately forced to sell? Like what's your outlook for your investments over the next 6 to 12 months?
Yeah, I think for us personally, we have a fairly unique platform, Jack. So I think our long-term investment strategy is more to invest in and with other managers than in their fund entities than it is to tackle individual transactions ourselves. So I have a pretty broad purview of managers across the U.S. on different strategies that people are engaged in. And so we tend to, so somebody will hire Verivest to help them set up a fund, which we will do. Then they'll engage us to do the back end administration. And if we like the strategy, we like the manager, we like the people, we like the deal flow, et cetera, our investment strategy and our fund would be set up to invest in that manager entity and then inject that capital into their fund as seed capital. So it's basically like venture capital for individual fund managers. So we're not actually picking and choosing individual deals these days. We're investing in managers and strategies that we like across the country. So I can talk to, what kind of strategies am I seeing out there that people are pursuing that I think have merit, in the current environment. If you wanted to go that direction.
I think I think so. I think that'd be great.
I mean, lots of people, obviously, there was a long period of time where interest rates were so low that it was very hard to do any sort of bridge lending unless you were, borrowing and making spreads off interest, and taking dollars in a big way. So there's a lot of mortgage pool funds that are getting started. I do see a fair number of people putting together vehicles that are designed to provide just what you said, rescue capital, mezz or pref equity. But even then, people are being very careful about, how do you underwrite a real estate deal? I mean, I see very niche-y stuff out there. I think there's a lot of foreclosures starting to happen. So you're seeing more of a lot of these fix and flip plays, back in the single family side. I've seen some build to rent strategies that are interesting, although just the costs these days are making that more difficult. I mean, I've seen affordable housing plays that look interesting. I mean, I've got clients that are setting up a combination of any type of fund that you can think about. Some people are out looking for distress office. Don't know that I love that play necessarily. I'm not sure what happens to office in the future, right? One of the things that's always fascinated me, Jack, about real estate is there are so many different ways to make money in real estate, and so many different strategies and ways that people try to bring value in the marketplace. There's always something, no matter what the market conditions are, that are interesting and I think, attractive at any given stage. So I've told people this analogy that I use. What's happening now is it's like a giant forest fire happening right now, right? And there's a lot of old growth that's getting burned to the ground right now, unfortunately. But every time that happens, it gives rise to new opportunities and new growth and new seeds that get planted. And there's a whole new crop of people that are coming along to take advantage of what the next wave of opportunities are going to be coming out of this, whether that's 6 months, 12 months, 24 months from now.
That's a great analogy. And, it's, I do completely agree. And then on the office side of it, I mean, who knows? I'm sure there's areas where they'll turn them into nice mixed use developments. There's still some need for some retail or mixed use. Certain states, more people are going back to the office than others, but it's never going back to the way it was before. I don't see, maybe it'll be at like 70 or 60% capacity to where it was before this happened.
Yeah, I'd say it's hard to imagine how it ever goes back to what it was. And you think about all of these cities and towns that have these buildings that have been built that are, multi-million-dollar properties that, what do you do with them? They're functionally obsolete, right? So, it's as I'd say fascinating and disruptive a time as I've ever seen in my 35-year career these days across all fronts. And then you throw in other types of developments in the world that aren't directly real estate related, but impacted, right? Like wars and supply chain disruptions and artificial intelligence and natural disasters and weather changes and all this stuff combined to impact things in ways that people have never seen before. So, figuring out how to navigate all of it, man. I mean, I'm like any other human. I mean, do the best you can to try to anticipate what's what, make good decisions, and at the end of the day, just do the very best you can with character and competence. And that's really all I know how to do.
Yeah, absolutely. That just made me think of. Are you familiar with an author named Peter Zeihan?
Yeah, I have. I've read or just seen a little bit of his stuff.
Yeah, so shout out to, he has a book called Disunited Nations. And as you were speaking about that, it did remind me of his book. And, there's times I go down this rabbit hole of, I just worry that the U.S., we're going to lose our currency, everything's going to go to hell. And then at least Peter Zeihan, kind of reminds me that the U.S. is still pretty well positioned overall. We have navigable rivers. We're still, the foremost power, and there's still a lot of positives. And the rest of the world is in, even with our interest rates up, it means the dollar is stronger because the rest of the world still, pours into the U.S. And if things go bad, the rest of the world even pours their money into the U.S. even more.
Yeah, if you go down a geopolitical path, right, there's a whole bunch of literature out there on why the United States is, in the position that it's in, right, with where we're located and the oceans on both sides and navigable rivers and arable land and all of those things, and the rule of law and so forth. So relatively speaking, I think you're right. The U.S. is in a good long-term position, but there's just so much instability in the world that it makes it very difficult to plan for the long term, because there's just so many things that are outside of someone's control that make it very challenging. So there's opportunities, challenges all at the same time, and navigating them is what people get, running alternative investments get paid to do.
That's great. So one of the goals I have, and one of the goals of this podcast and our Facebook group, is to help more people get exposure to alternative investments. There's statistics that, the average family office or someone that's worth $50 to $100 million has more than half of their money in private equity and real estate. Whereas the typical accredited investor that's maybe a 1 to 10 million net worth, close to, I don't know if it's 80 or 90% have almost all their money in stocks and bonds in the traditional system. Yeah. You've worked with probably thousands of investors, I'd imagine, over your career. What's your advice? What do you tell someone who's looking to expand out of just the traditional index funds, Vanguard stuff into these alternatives, which I firmly believe are a superior asset class, or at least one that should have at least significant exposure?
Yeah, no, I agree with that latter statement. I think a lot really depends on where they are, where they come from, what their own personal expertise is, right? And to your point, people that, let's say, have net worths in the 50 to 100 million, oftentimes the reason they have that net worth is because they were actively involved in this, and this is what contributed to it in the first place. Whereas people that maybe are in the smaller net worth and didn't have an entrepreneurial or real estate background, or coming out of a corporate America or whatever, they just have less familiarity, less exposure to this market. So they gain it through either registered investment advisors or financial planners and so forth. I think you're seeing an increased interest in that community to place a larger percentage of people's money in this sector. So, I do think that's all good. And then ultimately it comes down to, what are people's objectives? Are you trying to generate income, trying to generate growth? Are you trying to generate tax advantages? So you really got to understand, what your personal objectives are, right? And then find, again, character, competence, find good managers that know what they're doing and stand the best chance to, perform well, given all the uncertainty in the world.
Very, very well said. And I really appreciate your time and coming on the show. And I've actually modeled my business to some extent off of Fairway. When I was starting JCAM, I looked at the way you kind of built the fund of funds model, and I realized I didn't want to be an operator myself. And I don't have many competitors now, but this is you guys are a class act, and I actually went to your event last year. You guys are always had an abundance mentality. I went to your Laguna Beach investor event last year, and so because of that, I consider you guys friends, and it's just really good to have a conversation. And I think you provided a ton of value to our audience. So thank you for that.
Yeah, it was my pleasure, Jack. I appreciate the opportunity to be on the show, and it's been good getting to know you over the years, and it's been good to watch your success. And I appreciate the opportunity.
Great. Well, tell everyone how to find you guys.
Verivest, it's Verivest, Verivest.com is the best place to go. You can find me on there or Fairway America. We're actually in the process of updating our website on the Fairway side, so I think Verivest give you a good handle on kind of what the overall business model is, including our capital side of the equation. So Verivest.com, and reach me personally. Email address is matt.burk@verivest.com.
Great. And we'll put all that in the show notes as well. And do you have another event coming up, or was that one? Oh,
yeah, we don't have any on the horizon. I mean, we've talked a lot about putting on another one. I think with the market conditions and everything doing what they're doing, it's just spending the time and effort to put all that together. So I suspect Jack will put something together again in the future. But as of right now, we don't have anything on the calendar.
Gotcha. I always look for an excuse to get out to the West Coast, but really look forward to continuing to work with you guys. You provide a ton of value to the community, and hopefully we can do this again sometime.
Sounds good, man. Again, thank you again for having me. I appreciate it, and I look forward to being back.
Great. All right, everyone. Thanks a lot. We'll see you in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there, all up for the taking, You can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.